Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, I was going to share with you, as I mentioned, 3 common income generating strategies. So you want to get pen and paper out, take some notes on this one. This is one that's going to basically lay out for you a great way to protect yourself in market downturns as far as your income. One of the goals when it comes to retirement is we want to maintain a certain income, right? So if whatever that number is for you, whatever amount of income you need from your investments, typically we talked about what would be a safe drawdown. And there was, in the 80s and 90s in particular, there was something called the 4% rule. And the 4% rule basically stated you would be able to take 4% from your portfolio safely without worrying about running out of money. Then what happened? Well, 2000 through 2009 happened. And in that period, we saw a negative 10-year period. And it dramatically affected that 4% rule. And it changed how many economists then planners thought of the 4% rule, that maybe that wasn't as safe. Maybe they needed to be more around 2.5%. Now think about what you're looking at when we're talking about 4%. So if I want to take 4% from my portfolio, okay, for income, I'm going to take, so if I've got $1 million, that means I'm going to take $40,000, all right? $500,000, $20,000, so on. So I'm going to take, that's going to be the income that I pull from my portfolio each year safely. Now to do that, what has to happen? Well, I need to make at least 4%, right? If I don't want to see my portfolio shrinking over time, if I want to maintain my purchasing power, what needs to happen? Well, I've got to allow for inflation. Now, inflation's been relatively low, but let's say even at 2%, if I need to allow that my money needs to grow to stay ahead of inflation, there's 2 plus 4 is 6. Okay, am I making 6% on my money? What else needs to happen? I got taxes that I'm going to have to pay on that money. Am I accounting for taxes? How much might that be? So you can see how the amount of growth that you're going to need on your portfolio all of a sudden starts to get up there, right? And do you have a plan for that? Do you have a plan that's going to allow you to safely withdraw the amount that you can? And then you can see why many planners had adjusted that down. They're thinking, well, let's see if I do 2.5 and then I allow another 2% for inflation, which is low historically, by the way. More 3 to 4 might be more practical, but or 3 at least. But let's say 2 for the recent history. So now I'm at 4.5% I need to make on my money, and then I've got to pay taxes. So now maybe I'm at 5.5%. Are you making that kind of money on your money, that kind of return on your money? And what is your plan going forward based on what your income needs are going to be? There are some ways that you can hedge that bet. Okay, there are some strategies I'm going to share with you. One of those being these 3 common income generating strategies. So the first one is called systematic withdrawal. This is the simplest of them. So with systematic withdrawal, all it means is I'm going to start taking money out of my portfolio, okay, systematically each month, a certain amount. Now, in this most basic configuration, this goes to that 4% rule or 2.5% rule, depending on who you want to listen to, all right? That's what you're doing. You're saying, okay, I'm just going to take 4% out. I'm going to do whatever the valuation or the volatility and variations in the market are going to be. I'm taking 4, down, up, whatever. I'm taking 4, right? Now, the next piece of that is the downside, of course. In down markets, I'm eating up principal, right? And do I recover as quickly? It can set me up to potentially run out of money. I've shared this with you. It's called the this piece of sequence of returns risk, meaning that depending on when I retire, if I'm retiring into a down market, right, my portfolio could shrink and if I'm taking income, shrinking even more and make it difficult to recover from those bear markets. So this is where this is the weakness of systematic withdrawal. Now, one way to shore up, if you will, to make that systematic withdrawal work a little bit better is that we can put that money that we're going to be taking a systematic withdrawal from into a less volatile portfolio. So an example would be, let's say I'm investing in for growth, and I've got 75% of my money in equities, all right, in stocks. Well, that's going to, it's going to give me better growth over time. The more equities in a portfolio, the bigger the return over the long term. But what's the downside? In down markets, if I'm taking money out, right, I'm also going to be losing more in a down market. In other words, my portfolio is going to go down faster and more than it would be if I was in an equity portfolio that only, say, had 40% in stocks rather than 75% in stocks, right? Make sense? So what do we want to do? Well, what if we take some money that we need, 3 to 5 years worth of income that we've identified, and we put that in a separate portfolio? We say, well, I'll take my asset allocation over here. Maybe I only go 25% stocks. And in my growth piece of my portfolio, I've got 75% stocks, but I've got it where now I'm not going to take income from the 75% portfolio. I'm going to let it grow. This is a very easy way to help accommodate some volatility, maintain the stable income without worrying about using up money. Now, here's the other piece. How do you know how much to put in it? And this goes back to an assessment of your current portfolio. All right? So, for instance, when it comes to your income, you determine I'm going to need X amount of income to cover my expenses, my lifestyle expenses, right? I'm going to need to pull a certain amount out of my portfolios to go with my Social Security, pension, whatever I have for other income sources. And that amount, I then say that's $20,000 a year or $40,000 a year, pick your number. Whatever, let's say $40,000, right? If you need $40,000 a year out, how are you going to accommodate that? Okay, so I would need, if I'm looking at it, if I'm using proper asset allocation modeling, then I know that I just need to accommodate basically about 3 years worth. I need to write out about a 3-year volatility period, because over the last 20, in fact, if you go back even 30, 40 years with the portfolios, the model portfolios that I talked to you about and that I use in my practice, for instance, when we look at those, we've never had more than a 3-year period where we've had it down. And even then, it's only been, it was more like a break even than down, depending on how much equities you've made, how much you had as far as the equity component. All right, so what am I doing then? I'm going to take the amount that's in that smaller amount, so it's three years worth of expenses, worth of income that I'm going to need to cover my expenses, and that amount, so if I'm using a number like $40,000 a year, then I need $120,000 set aside in this stable portfolio. And there I'm going to just have 25% in equities, a lot less volatility. In fact, it's never had more than, I think, 2 years. In fact, I don't even think it was 2 years. It wasn't a full 2 years that was down. So I can easily write out the volatility over a period like that, and then I can add to it when the market is going back up again. All right, I'm going to share some more income strategies with you and finish off this bit about systematic withdrawals. This is just one way that you can help manage risk in your portfolio in retirement to get the income you need to be able to attain and maintain your standard of living, quality of life, no matter how long you live. All right? More on that, but first a break. Join me here. We'll be right back on the Retirement Report.